Dividends make up a significant part of the total investment return when investing in companies, but they are set to plummet in 2020. Thank you, COVID-19. New research suggests that global dividend payouts could fall by as much as 20% this year, and the future doesn't look that great for 2021 either. So in this video, I take a look at the role dividends play in an investment portfolio and also the findings of this new research coming up in this video. Hi everyone, I'm Martin Bamford, a chartered financial planner and informed choice, and in this video I take a look at new research which predicts that global dividend payouts could fall by as much as 20% this year, and the future doesn't look that bright either. I'm looking at new research published by fund management group Janus Henderson, part of their Global Dividend Index research, and it's forecasting that global dividends could fall this year between 17.5% and 20%. That's a fall in total dividend payouts this year of some $263 billion. Before we get to the findings and predictions in the report, please do press that subscribe button and please like this video too. On this channel, you'll find lots of videos and regularly updated videos about investing, economics, personal finance, and happiness. So press subscribe to make sure you get notified of future videos as they come out. Before we get into the report as well, let's go back to basics just a little bit for a moment or two. What is a dividend? Well, simply put, a dividend is a share of the profits in a company being distributed to you as a shareholder. As a shareholder, you're the part owner of a company and you hope to benefit from that part ownership in two main ways. One is by getting a share of the profits, that dividend payout, and the other is by seeing some growth in the value of your shareholding over time. When we look at market returns, when we look at how the FTSE 100 or the S&P 500 index is going up and down in value, that is made up of the growth or losses from all of the companies within that index. So as a part owner of a particular listed company, you get some shareholder return from dividend payouts and hopefully some shareholder return from capital growth too. But it's those two parts together that makes up the total return. That's a very simplistic view of it. Of course, nothing in life is that simple. Different classes of shares in companies, some have dividend payout rights, some don't, and you don't automatically receive all of the profits that a company generates in terms of your share of those profits. That has to be decided on by the board of directors and then voted for approval by shareholders who have voting rights. So it's not an automatic process. Company makes profit, profit gets paid out as dividends. That actually has a bit of discretion behind it as well. But dividends do make up a really important component of the total return from investing. On average, in an average year, about a third of the total return will come from dividend payouts. And dividends are important too because of this notion of compound returns. Simply put, you don't go out and spend your dividends, you reinvest them and they accumulate more shares in the company over time. So in the future, because of that compounding, you get paid dividends on dividends on dividends. And it was Albert Einstein who reportedly said that compound interest is the eighth wonder of the world. I'm not sure he actually did say that, but it's often attributed to him. If you get compound interest in compound investment returns, if you understand that concept, that's the path to building wealth over the longer term. But 2020 has been a really bad year for global dividend payouts. This Janus Henderson report suggests that global dividends could be cut by as much as 20% this year. That would make it the worst year for dividend payouts since 2009 in the aftermath of the global financial crisis. And looking ahead to 2021, things for dividends could be a little better, but it will depend to a large extent on the path of the pandemic, how quickly the economy gets back to normal in 2021, and how soon in the year things get back to normal as well. We know that global stocks cut their dividend payouts by some $55 billion in the third quarter, after having cut them by about $108 billion in the second quarter. So that's cuts of 11.4% and 20% respectively. Significant cuts, although, as I'll come on to explain in a minute, there are still massive amounts of dividends being paid by these global companies. They're just much lower than they were thought to be, or indeed they were paid out last year. Those cuts in dividends, those falls in dividends this year are not as bad as many analysts had expected at the start of the pandemic when there was so much uncertainty. We do now have a much clearer path ahead, and we understand a lot more about what recovery from the pandemic might look like, what impact that's likely to have on the economy, what impact that's likely to have on companies. So while a 20% cut is significant, it could have been a whole lot worse. The report from Janus Henderson says our best case now sees a fall of minus 17.5% to $1.2 trillion on an underlying basis. Our worst case sees underlying dividends declining minus 20.2% to $1.16 trillion. So as I said, a big cut, but also still over $1 trillion of dividends being paid out worldwide, even on their worst case scenario. So there's still an important role for dividends to play in the total return for investors. Jane Shoemake, who is the investment director for global equity income at Janus Henderson, said, "This has been the worst year since the global financial crisis, but if life starts to return to some form of normality, even some of the hardest hit companies, such as travel, leisure and retail firms, will be able to start paying dividends again." And Janus Henderson, looking ahead to 2021, thinks the dividend rebound could be as high as 12%. And obviously that's not going to make up for all of the lost ground we saw this year, but it is a significant improvement. But again, depends really on this path of the pandemic, how quickly things are able to get back to normal, how quickly companies can get back to trading almost as normal as they were before the pandemic struck. And as well as the path of the pandemic, the progress of dividends in 2021 is going to depend to a very large extent on regulatory action, particularly here in Europe, where banking stocks have been hamstrung and limited. They've seen their dividend payments capped by European financial regulators. The same picture has happened across the world. But whether dividends can recover in 2021 will depend to a large extent on whether regulators, financial regulators, allow banking stocks to resume payment. Looking then at the third quarter of this year for dividend payments, the latest set of data we have, we know that hardest hit was the consumer discretionary sector, down about 43% in terms of their dividend payouts in the third quarter. So car manufacturers in particular very badly hit, but also the leisure sector having to cut its dividends quite significantly. There are also big dividend cuts across the media, aerospace and banking sectors, but we saw some dividend increases in the third quarter for pharmaceuticals and food sectors. And that's a reminder, I think, that this pandemic hasn't treated every company in the same way. Some sectors have actually profited from the pandemic. Our changing lifestyles have meant that we've gone and we've spent more money on food, for example, on online communication. Zoom has been one of the big winners from this pandemic. But at the same time, we've got to look ahead to the vaccine and the potential for pharmaceutical companies to profit from the rollout of a vaccine. And some very good news in the past couple of weeks about 3 main vaccines in late-stage trials seeking emergency regulatory approval. That should have a big lifting effect on the ability for the pharmaceutical sector to pay out dividends next year. Here in the UK, dividend payouts in the third quarter down by 42%, largely driven by falling dividends from banking stocks, but also from the oil sector, both sectors quite badly hit in the third quarter. And a similar level of dividend cuts in the third quarter in Australia, where dividends were down about 40%. Again, restrictions on dividend payments in the banking sector there driving that 40% fall. In the US in the third quarter, dividend payments only down by 3.9%, but that's to a great extent because of the way dividends and profit distribution is dealt with in the US for tax reasons largely. So profits from US companies don't tend to be paid out as large dividend payments, but as share buybacks, and that's how shareholders profit from profits in companies. They get share buybacks, but there were restrictions imposed by the US Federal Reserve back in the summer, particularly on the banking sector. The 8 largest banking stocks in the US earlier in the summer had voluntarily stopped share buybacks, and then the US Federal Reserve stepped in and banned them from doing so. So not much to move really in the third quarter in terms of US dividend payments. In Japan in the third quarter, dividend payouts down by 16%, but we saw rising dividend payments in China, up by 3.3%, and in Hong Kong, up by 10% in the third quarter. And that's quite an interesting indicator of what could come later across the globe. China ahead of the curve in terms of its recovery from the pandemic. Obviously it hit there a lot earlier. It started there, originated there in China. So they've come out of it much earlier and seen some sort of return to economic normality, and therefore dividends rising by 3.3% in the third quarter. Likewise in Hong Kong, up by 10% in the third quarter. So that could be a taste of what's to come across the rest of the world in early 2021 onwards. And then the report also notes that Microsoft is set to become the biggest dividend payer in the world for the first time in the fourth quarter, with their fourth quarter dividend payout on track to rise by 10%. Now, really for the past decade, the main dominant investment story has been the rise of the tech giants, Microsoft included. And these companies are throwing off cash like you wouldn't believe. So having to distribute that cash, that profit to shareholders. And one way they're doing it, as per Microsoft, is through a larger dividend payment. But as I mentioned, these tech companies, because they tend to be US based, they do have some tax restrictions on paying shareholder value back. So dividends not a particularly favoured way of paying shareholders in the US. Share buybacks could be the way that happens, but they are sitting on large cash reserves and therefore have to pay their shareholders from some share of that profit in some way. So I think the conclusion from this Global Dividend Index report is yes, 2020 not likely to be a great year for dividends, but dividends across the world from global companies still paying out over $1 trillion to shareholders this year and continuing to make up an important part of total returns. Now, of course, as investors, we don't look at the short term, do we? We don't get too fixed, too myopic when it comes to 1 year performance. It's only 1 year, and this has been a particularly bad year for all sorts of reasons. But looking at the bigger picture, looking at the long-term investment return, which is all that really matters, dividends continuing to play an important part in total investment returns. However, investors who rely on what we call a natural income from their portfolios, who take that dividend each year and spend it to fund their living expenses, they might be looking at this and rethinking their investment withdrawal strategy. We hear often, don't we, about that headline 4% rule when it comes to what is sustainable, what is safe to withdraw from a portfolio over time. That depends on a whole variety of factors, so don't take that 4% at face value. Please do think about the asset mix you have, about your individual investment objectives and how things work in your portfolio. As financial planners, one of the really important things we do is to calculate a personalised sustainable withdrawal rate for our clients in retirement. So if you have an investment portfolio and you're withdrawing a certain amount from it each year, make sure you don't run out of money before you run out of life. Pick a number that works for you. What role do dividend paying stocks have within your own investment portfolio? Let me know in the comments down below. Please do subscribe to this video. Please do press that like button as well. It'd be most appreciated. Until next time, thank you for watching. I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.